Hey everyone, Michael from Bullion Now, bullionnow.com.au. So we are continuing on with our Back to Basics series, and this one is on hedging. Now, it's a term that's bandied around a lot, particularly by bullion dealers and traders, but what does it actually mean, and how do you use it both as a bullion dealer, which is what we do on a daily basis, but also the sort of thoughts that need to go through your brain when you're considering your investments. So hedging it sounds complicated as I explain it out, but it's actually quite a simple concept. So if you can imagine a number, the number of ounces or the number of kilos of gold or silver or platinum or palladium or rhodium or whatever it is that you want to maintain in your stack. Now, we have, as a bullion dealer, we have this imaginary number in our mind, and we try and keep everything at about that number. Now, when we buy something, that makes us go what we call long, which means we're above that imaginary number, whether that number's 0 or 1,000 units or whatever, it doesn't matter. So when we buy in stock, we go above that imaginary number. When we sell out stock, we go below that imaginary number. But our aim is to always come back to that imaginary number. Now, why would that be so important to us? The last couple of weeks have been the perfect example of why we want to stay at our, what we call a neutral position, which is that imaginary 1,000 units that I was talking about before. So 2 weeks ago, approximately, gold was nudging well above, or just above $3,800 an ounce in Australian dollars. And I'm going to use Australian dollars through this whole piece, but you can translate that into another currency if you're in another country. So we were nudging $3,800 an ounce. So you can imagine, as a bullion dealer, if we bought a whole stack of gold at $3,800 an ounce, and then into the next week when we started selling it, the price had actually dropped, and it dropped all the way down to $36.50-ish, somewhere in there. In fact, it got below that. It got down into the $36.30 an ounce for gold in Australian dollar terms. So you can imagine a scenario where we've bought 100 ounces of gold or 200 or 300 ounces of gold at 3,800, and we're now selling it at 36.50. You can see how very, very quickly we would go out of business. We'd sold it all down, and as it went down to 36.50, and then as I'm standing here, or sitting here, I should say, right now, the price is now currently nudging that 37.20, 37.30. So you can imagine, if I've bought it at 38, we've sold it all the way down to 36.50 and all the way back up to 37.20, and now I've got to buy it back again. So not only have I bought high, I've sold low, and I'm buying high again. Really, really, really quick way to go out of business. So what we try and do is maintain that, for this example, that imaginary 1,000 unit number. So if we're buying, we're selling, and if we're selling, we're buying. And that way, we're always maintaining the same spot price. So on the Friday that I'm referring to, where we bought at $3,800, we'd actually been selling that whole day at around that $3,800 mark. So we were replacing stock that we'd actually sold. So when it dropped down on the following week down to that $36.50, it didn't actually matter, because we'd bought and sold at the same price. And then on the Monday, I can't remember what the Monday's figure was, but let's say it had dropped $30 an ounce. We were selling it at that $30 an ounce again, but we're like $30 an ounce below what we'd been selling it for on Friday, or buying it on Friday. But we were replacing it at exactly the same spot price at that time. And throughout that whole week, we were always buying and selling, buying and selling, buying and selling at the same price. And that way, we don't make a loss on the spot price movement. We also don't make a profit on the spot price movement. And quite often people will say, oh, spot's jumped up, you must be really happy, you must be making a lot of money. We don't actually make any money at all out of that spot price movement, because we're buying and selling the whole time, trying to maintain that imaginary 1,000 unit number. The profit that we make at the end of the day is purely that, or part of, it's not all of, that premium over spot. We take a component of that. And while we keep doing that, we will stay in business. As soon as we start relying on spot price movements, we will go out of business really, really quickly, because Murphy's Law rules, you can guarantee that if you buy it at this price the next day, and we have so many customers that agree with us, you buy at this price and the next day it drops down a couple of percent, 2%, 5%, whatever it is. Really quick way to go out of business as a bullion dealer. So how does this impact you as an investor though? Well, you probably won't hedge. You're buying for the long term. You're not buying, selling, buying, selling, buying, selling, buying, selling. So in some ways it doesn't impact you. You want to buy it today and you're probably going to hold it for a year, 5 years, 10 years, maybe far longer into the horizon. I had a customer in not that long ago who'd been holding the ounces of gold that they held. They'd been holding them for almost 40 years. And that's the sort of long-term investment that gold's really good for. But hedging is still really important for you as an investor. Why? Because you need to make sure that your bullion dealer that you're dealing with, whether it be Bullion Now, your local bullion dealer or someone else, you need to make sure that they've got a good hedging platform in place. Because if they don't, they're not going to be around in 5 years' time, I almost guarantee it. Because they will get caught on the wrong side of a run, whether it be selling low, buying high, or whether they get caught the other way around, where they've sold high, but it's gone even higher. All those sorts of combinations and things occur at different times, and they will very, very quickly go broke because we only make dollars off a transaction. You know, we sell an ounce of gold, we might make $10 or $15 or $20 net profit out of it. You can very quickly lose that in a price movement of the size that we're seeing at the moment. And I firmly believe, I'm not going to tell you spot price is going to be a certain price in the next month or 6 months or 12 months, but I will pretty much guarantee that the next 6 to 12 months we are going to see some really serious volatility across all of the precious metals, all 5 of them. So one of your due diligence checks is to get out there and actually talk to your bullion dealer and just casually in that conversation with your bullion dealer say, do you guys hedge? And if the answer is yes, that shows that they're a good bullion dealer and they're aware of what's going on in their business. If they say, no, we don't believe in that, we try and move in, like pick up some extra dollars in the spot price movement, your alarm bells should start ringing. All right, that's it for now. We'll talk again very, very soon. If you want more information, give us a call, 1300 84 84 10. Send us an email, sales@bullionnow.com.au, or drop in and see us, level 6 227 Collins Street in Melbourne. See you soon.